Welcome to GRE. I'm your host, Keith Weinhold. I answer 3 of your listener questions, then learn why LA area landlords got a bad name during this month's awful Southern California wildfires. Finally, why Canadians cannot buy houses anymore, and what lessons you can learn from Canada's real estate mistakes and the abject lunacy there today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Gatlinburg, Tennessee to Pittsburgh, Pennsylvania, and across 188 nations worldwide. I'm Keith Weinhold, and you are inside this week's installment of the program known as Get Rich Education. I'm grateful that you're here, but you're not here for me. You are here for you. So let's talk about you and some of the listener questions that you wrote into the show about. And as usual, whenever I have a batch of listener questions, I answer the beginner level questions first and then move on to more advanced questions. The first one comes from Jeanette in Seaford, Delaware. Jeanette asks, I only have a little money to invest in real estate. How do I get started with just a small amount of money? All right, Jeanette, well, first I would talk to a lender. You have to talk to a mortgage specialist or a loan officer to find out what you qualify for. You're basically getting them to punch holes into your financial picture, and then that way, Jeanette, you will know what holes to go mend. So your loan officer is essentially giving you a free troubleshooting session. Now, our investment coaches here at GRE help you with some of that. But GRE doesn't originate loans, so you want to get with someone like a Ridge Lending Group for help. And now, what are some of the holes that a mortgage lender might poke into your finances, Jeanette? Well, getting your credit score up, and they'll help you with that strategy. Or you simply need more dollars in savings in what your mortgage loan underwriter calls reserves. Or you might need to establish a 2-year job history, or you have to, say, pay off your car loan in order to get your debt-to-income ratio lower, or whatever it is. And since at GRE Marketplace, the least expensive income property is probably about $120,000 right now, a number that keeps going up with inflation, but what you would need is 23 to 25% of that between your down payment and closing costs. All right, Jeanette, so then about 28 to 30K, that is the minimum lump of cash that you'll need to buy a property that is already fixed up and ready for a tenant. And that is a great way to start in real estate investing if you want to maintain your standard of living. Okay, that is therefore the lowest entry point that you can do that. But if you're temporarily willing to let your quality of life slide for a couple years and maybe live communally, you can put as little as 3% down on a primary residence and then rent out the other rooms. Okay, that's the house hacking model. But depending on your setup, maybe you're sharing a kitchen with roommates or suite mates, and therefore that temporary loss in quality of life. Maybe you can even Airbnb it, a short-term rental, in which case you will be buying the furniture, however. Now, with a 3% down payment on an owner-occupied house hack like that, you're probably going to have to pay a PMI premium, a private mortgage insurance premium of a few $100s per month. But still, this does get you in with very little money, since that's what you're asking about, Jeanette. And finally, the third thing I'll bring up here is that you can get a combination of maintaining your standard of living and putting a small down payment on a property by using an FHA loan and 3.5% down. And you can do that with a single-family home, duplex, triplex, or fourplex, living in one unit and renting out the others. So yes, you get both this way. But I will not go into the details on the FHA because I have described that in detail on other episodes, since it's how I started out myself. But there are a number of options right there for you to inquire about, Jeanette, all starting with an investment-centric mortgage lender like ridgelendinggroup.com. The next question comes from Jared in Pocatello, Idaho. Jared asks, Keith, in the past year, my duplex in Pocatello went up in value 5% from $400K to $420K. How do I know how much of that 5% is true appreciation and what portion of the 5% is from inflation? Oh, that is such a devastatingly cool question, Jared. And that's exactly what I thought when I saw that question come in. Okay, so basically Jared is asking, say in this 5% price increase, is 3% from inflation and 2% from appreciation, for example? Or like, what is the breakout of those two components of the price change? And a lot of people don't understand the difference and even know enough to ask a question this good. So props to you there, Jared. One thing you cannot do is just look at CPI inflation over the last year for the U.S., which is 2.9%, and then say, oh, well, then I guess the other 2.1% must be appreciation, therefore. No, you can't really do that. There's more to it than that for a lot of reasons. I mean, consumer price inflation, like on a pound of ground beef at the supermarket, that is different from asset price inflation. And there are a lot of other reasons too. Appreciation is distinctly different from inflation because the value of your property increasing 5%, that has to do with the attractiveness of your property to the marketplace. Now, there are attributes with appreciation like proximity to high-paying jobs, proximity to highways and shopping and desirable schools, which are basically those axiomatic location qualities. Now, I'm going to assume that you did not make an improvement or a renovation to the property, Jared, because obviously that would hike up the value. Now, other appreciation attributes that are distinctly different from inflation are things like population growth and wage growth in your area. What can really pump up appreciation is if the remaining availability of developable land starts shrinking and shriveling up in a desirable location. Contrary to popular belief, mortgage rates have little to do with appreciation. We can leave that out of this discussion. Now, how this is different from inflation is that inflation is not about the intrinsic value. Rather, inflation is the price of the home increasing because the currency is worth less. Now, I hope that you find that explanation satisfying, Jared, but what is dissatisfying is that it's actually hard to pin down a number and say, was this 2.5% appreciation and 2.5% inflation or any other combination? And that's because inflation itself is practically impossible to accurately measure. And a lot of that has to do with an inflationary basket of goods that is just exceedingly difficult to adjust for attributes like quality and utility and substitution. So, Jared, it is likely that your duplex's 5% value increase is an amalgamation of both appreciation and inflation. That part I can confirm, but the exact breakdown for each is virtually incalculable. Super insightful question there, Jared. The third and final of our 3 listener questions to get the show started today, and then I'll get into landlords in the LA wildfires and Canada versus U.S. real estate. The final question today is from Jeter in Roseville, California. I know where Roseville is. It's just northeast of Sacramento. And I'm not sure if Jeter, Jeter, is your first name or your last name, like former Yankees shortstop Derek Jeter, but only one name came in here. Jeter asks, Keith, I am a true believer in GRE principles. I'm looking to pounce on some property this year and get leverage and other people's money working for me instead of only getting my money to work for me in my company's 401k. Let me just interject here. You really get it. You really get it, Jeter. Continuing on with your question, with mortgage rates around 7%, I'd love to know where you think interest rates are headed next and what is going to make rates move. Thanks, Jeter. Well, I've got to tell you, Jeter, not only do I avoid predicting future interest rates, but I don't know of anyone in the world that can predict interest rates with high reliability, especially over the medium to long term. James Grant, he's based in New York City. He puts out a publication called Grant's Interest Rate Observer that might just give you a better than 50-50 shot of where they're headed next. He's a well-regarded source. In fact, I saw James Grant speak in person a couple months ago, but I wouldn't put too much credence in any interest rate predictor out there. Now, just 11 days ago, I sent our newsletter subscribers a graphic of just how bad, I mean really awful, that recent interest rate predictions have been. I've never seen a chart like this. This chart looked like a centipede. Okay, the bold line was the actual federal funds rate that was like the centipede's body, and all the hundreds of legs coming off this line were predictions that others had made, all deviating from the true line, the centipede body, which is what the rate really was. I mean, prominent experts' rate predictions have a track record that's more abysmal than everyone saying we'd surely have a man on Mars by now. Terrible. Jeter, when you look at interest rate predictions, you are looking at a waste of your time. They're about as reliable as a weather app in a tornado. A year ago, the collective brain trusts of all the economic wizards believed with devotion and alacrity that mortgage rates would be sub 6 now. Instead, they are still about 7, which might correspond to a 3 or 3.5% federal funds rate. They all thought the federal funds rate would be near 3 by now, but it's more like 4.5 today. And what's hilarious is that in more recent years, the Fed even tells us what they plan to do next. They even tell us. It's a little like having the answers to the test, and yet you still fail the test. You've got the cheat sheet, and you still aren't doing any better. How can this possibly be? Well, the reason that I don't make interest rate predictions is because it is a surefire way to look foolish. Jeter, to answer the second part of your question, what moves interest rates around? The answer is, well, it's really broad economic forces and political forces. That is why it's tough. And this includes jobs reports, supply and demand of credit, inflation, a pandemic, a surprise new war in the Middle East, tariffs, GDP reports, surprise election outcomes, a massive change in tax policy, and more. I mean, it is total entropy. Now, one thing we know is that persistently higher inflation will soon result in higher rates, just like we saw in 2022. I mean, rates rise in a bullish, robust, and optimistic economy. And another thing that we do know is that sustained fear causes rates to fall. That's why when you look at a chart, you see interest rates of all kinds plunged like a cliff diver during the 2001 dot-com recession, the 2008 GFC, and the 2020 COVID pandemic. The reason that rates fall during fearful times just like those is because the economy needs the help. And a little pro tip for you here, Jeter, when a recession begins, it's more likely than not that rates will fall. But see, it can be hard to predict a recession, as we've all found out recently. We just came off 3 Fed interest rate cuts late last year, and that was a little weird because the economy does not need the help. That is sort of like offering Gatorade to someone that's not even sweating, okay? And when rates scrape the ocean bottom floor at 0 from 2009 to 2016, and then again from 2020 to 2022, that's unhealthy. Natural market forces would mean that there's a cost to receive a service like borrowing money. Well, with 0 rates, it feels like no one wants to save and everyone wants to borrow and spend at 0 rates. It is time to all out, ball out. My 2-time GRE podcast guest here on the show and super smart guy, Dr. Chris Martenson, he thinks that rates are generally going to go higher from here, but you don't have to look far. You can find other wise guys that say they're going lower. At the last Fed meeting last year, they disappointed markets by signaling plans to only cut rates twice this year instead of the 4 cuts that were previously expected. And now that's even changed since then. And a lot of people question if those 2 cuts are even going to happen this year, given things like a hot jobs report that came flying in and still too high inflation. So this is kind of like expecting a decadent dessert of rate cuts. And instead, you get like one Biscoff cookie like they give you in economy on the plane. So, Jeter, that's why I don't forecast rates. I don't think anyone can. But now at least you have a couple resources, and you also know what factors move rates around. Now, if you want a fun, real-time pulse on the market, check out Poilievre. You might have heard of it by now. It's a site where you can place bets on various outcomes, a lot of non-sports bets. You can see people put their money where their mouth is. You don't have to make a wager yourself. You can just see what people are wagering on. There are wagers on Fed interest rate decisions there at Poilievre. You can even place a bet on if Jerome Powell says good afternoon at his next press conference over there on Poilievre. I'm not kidding. Right now, the odds of him saying good afternoon at his next press conference are 96%. So remember this. The market has always felt confident about where rates are headed, and the market has always been wrong. Interest rates don't drive property values. Their intrinsic worth is based on the timeless stuff, location, amenities, income, occupancy, size, density, business case, exit options, and operating costs. Those are the things that drive property values. The bottom line with interest rates is that nobody knows the future. Interest rates direction is a pinball game of black swans and policy pivots. So instead, focus on the big things that you can control, like how many dollars you have leveraging properties and keeping your operations on those properties efficient. So, Jeter, waiting to buy property generally harms an investor more than it helps them because it's dollars on the sidelines that are paying the opportunity cost of not leveraging other people's money. Of course, if you buy your property at whatever interest rate today and rates soon fall like a knife, well, then you can refinance at the lower rate, all while leverage keeps compounding and building your wealth. Thanks for the question, Jeter. If you have a listener question or comment or feedback of any type for us, as always, you can visit us at getricheducation.com/contact for either written or voice communication there. Like I said earlier, that amazingly interesting centipede-like chart of just how dreadful interest rate predictions have really been, that was in our recent newsletter. Now, it's too late for you to get that issue, but to get more like them, you can get our Don't Quit Your Daydream newsletter completely free. Just text GRE to 66866. That's text GRE to 66866. Now, when it comes to this month's historically bad, devastating LA area wildfires, I heard from a friend in that area last week. She lives just south of LA, and her house was spared, fortunately, but she's been busy helping friends in the LA area who have lost their homes and businesses. It is truly tragic. And you know what she told me is the biggest, most compelling need right now? And I put some credence in this since it's an independent, on-the-ground report. This is outside of major media. Displaced residents' number one need is not food. It's not water. It's not clothing. It's not heat. It's not even community. With thousands of families without homes, the urgent need is for housing. You might not find that surprising. That's what she shared with me. I mean, it is a need so dire that even a family of 6 would consider a small mobile home or an RV rental to help with temporary housing. And a lot of these displaced families were, you got to consider the fact that before the fire, they were living in above average homes, even luxury homes. Now, as far as LA area landlords that have housing to rent out, a lot of those landlords have jacked up the rent price. California's anti-price gouging laws make it illegal for landlords to raise rent by more than 10% in the first month to 6 months after a disaster is declared. Now, the BBC reported that one resident who lost their home in the historic California wildfires found a rental property that was previously priced at $13,000 per month. They offered $20,000 per month, and the landlord countered with $23,000. That is a 75% price hike, and it's not the only example. A Bel Air home located in an evacuation warning zone was listed on Zillow recently at $29,500 a month. That is an 86% hike from its September of last year price. That's according to the outlet called LAist. Another realtor raised an Encino, California listing from $9,000 per month at the beginning of this month to $11,500 after the fires started. That's according to the LA Times. The realtor then backpedaled to abide by the 10% rule, which she said that she did not know about. And for a little context there, yes, those rent prices sound high, and LA rent was already high. It averaged $2,820 a month. That's compared to $1,983 a month nationally. Those figures are per Zillow. Now, I don't know what percentage of LA landlords are engaging in, I guess what I'll call extortionate behavior. But even if it's the vast minority of landlords, that gives them a bad name to have the word landlord in headlines like this. And is this behavior extortionate? In some cases, it probably is. I suspect, just a guess here, that some landlords might think they have a chance of insurance paying some or all of the higher rent for their tenant that was displaced from their original home. But let's keep things in perspective here. What this does to good landlords' reputations, that's not the story here. The story and the effort should be in helping the displaced people. And of course, there are so many angles to the devastating LA wildfires. One of them is that many believe zoning laws pushed homes out into fire-prone areas. I recently shared that Reason.com article with you in our free newsletter. So again, to get our Don't Quit Your Daydream newsletter completely free, which I write every word of myself, text GRE to 66866. You can do it now while it's on your mind. Hit pause and text GRE to 66866. the abject lunacy in Canada's real estate market, and what U.S. residents and others can learn from all this. That's next. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Shaylee Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the liquidity fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25,000. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
This is GRE Real Estate Investment Coach Naresh Vissa. Don't live below your means, grow your means. Listen to Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. Let's discuss the Canadian economy and Canadian real estate, because even if you live in the U.S. or Central America or Europe or one of the other 187 nations that we're heard in outside the U.S., there are lessons here for you, and there are lessons here for me as well. There is some just jaw-dropping material that I'm about to share with you. And I won't discuss the politics of it because that's not GRE's lane. Instead, it is the policy. Earlier this month, Canada's equivalent of the president, Prime Minister Justin Trudeau, announced that he will be resigning soon, and Trudeau's been under a lot of criticism. At last check, his approval rating was a miserable 22%. Now, most people think that the next and the future Prime Minister of Canada will be a man named Pierre Poilievre. In fact, the wagering site Polymarket has Poilievre with an over 80% chance of being Canada's next Prime Minister. And you will hear him speak shortly here. And yes, that is how an Anglophone pronounces his last name, Poilievre. In a recent interview with Dr. Jordan Peterson, you'll listen into here shortly, Poilievre, Canada's likely next leader here. First, he describes some of the problems with Canada's economy, and then he'll get into their real estate market. Right now, the median home price in the United States is about $450,000. You might think that Canada's should be lower because Canada has more land than the U.S., and Canada has just about 1/9 of the U.S. population, so a low population density. I mean, the U.S.'s population density is more than 10 times Canada's. But no, due to some of these policies, it's just the opposite because Canada's average home is over $725,000. Yeah, that's just for a basic home. I've got to admit, I did not know who Poilievre was until just a couple months ago. I'm starting to like him the more that I listen to him. He's a clear thinker and a clear speaker. Here is a clip of Canada's likely next leader talking about Canada's problems. This is 10.5 minutes long. I'm going to listen to this again with you right now, and then I will come back along with you to comment. This is why you can't buy a house in Trudeau's Canada.
Our productivity is another major problem. Like right now, and that's productivity sounds complicated. It's actually extremely simple. You just take the GDP and you divide it by the hours worked in the country. So American GDP is $80. So for every hour an American worker works, on average, he or she produces $80 of GDP. In Canada, it's 50. So that's every hour. So that means we have to work 60% more just to make the same amount and have the same level of income to buy food and housing. And so now that sounds like a bunch of wonk speak that might seem like it only matters to someone staring at a spreadsheet or a graph or a chart. But in fact, that's reflected in the fact that our 2 million people are lined up at food banks because they can't afford food, and 80% of youth can't afford homes. And our quality of life and the things we can afford to provide our kids have fallen back so much.
Well,
There's a real
pretty
life.
stark and easily comprehensible statistic.
Yeah.
I mean, if you work and you produce $80 worth of goods and services in an hour compared to working and producing 50, obviously that's a substantial shortfall.
Yeah.
So, and is there a starker indicator of the economic disparity between the U.S. and Canada than that? Or do you think that's the primary statistic?
I mean, I think housing costs are another one. There was a study out just 10 days ago that has Toronto and Vancouver now by far the most unaffordable housing markets in North America. And so, housing costs are 50% higher in Toronto than they are in Chicago, even though Chicago workers make 50% more money. The same is true between Vancouver and Seattle. Seattle workers make way more than Vancouver workers, but housing is 60 or 70% more expensive in Vancouver. So on all the measures,
less by a lot.
Yes. By a lot.
Yeah.
And we're paying more.
Paying more by a lot.
Yeah.
Right. And most of that's transpired in the last 10 years.
Yes. And we're paying the difference by accumulating enormous quantities of debt. Our households are by far the most indebted in the G7. When you divide total household debt by GDP, we now have a bigger stock of household debt than our entire economy. We are more indebted as households than the Americans were right before the 2008 financial crisis. And so what we have as a model in Canada is we have artificial scarcity imposed by a very heavy and restrictive state, confiscatory state. So that suppresses production. Mm-hmm. But in order to allow for consumption, we print money and borrow money and then flood the economy with that money.
Okay, so that's another problem. So that's the inflationary problem.
Yes.
Now, the problem with inflation, just many problems with inflation, but one of them is that it particularly punishes people who are thrifty and who save.
Yes.
Right. So inflation punishes the people who forego gratification to invest in the future.
That's right.
Right. So that's a very bad idea.
It's a horrible. Inflation is the single most immoral tax for so many reasons. One, it takes from savers and people who are trying to be responsible, thus making it impossible to be responsible. Right. Because you will, if you refuse to play the inflation game of borrowing money to buy things you can't afford, someone else inevitably will, and you won't be able to afford anything. Mm-hmm. Mm-hmm. So you ultimately have to act responsibly. It's like Milton Friedman was asked, what would you do with your money in times of inflation? He said, spend it.
Right.
Like the first thing you want to do when inflation is out of control is to make sure you get rid of this thing that's losing its value. The second reason it's immoral is it takes from the poor, because the poorest people they do not have the ability to buy inflation-proof assets like gold and real estate and fancy watches and art collections and fancy wines and things that go up with or even exceed inflation. So it's a very big wealth transfer from the poor and the working class to the very, very wealthy. A very small group of people actually get richer.
So the socialist policies that provide goods and services to Canadians, let's say, or denizens of other countries, by printing money, actually punish the poor brutally.
Oh, absolutely.
In consequence of the inflation that they generate.
Yes. I mean, all the socialist policies in practice redistribute from the working class to the super wealthy in practice. Mm-hmm. And I can prove that again and again and again.
In theory.
In practice.
Yeah.
In practice, they all the redistribution that happens in these so-called socialist countries ultimately goes from the working class to the super wealthy. That is the reality. But just one last thing on inflation. The final reason why it's so immoral is nobody votes on it. The basic principle of our parliamentary system is the government can't tax what Parliament has not voted. The people no taxation without representation, right? But no one ever votes to have the money printing happen. And so the inflation is adopted secretly, and you blame the grocer because groceries are more expensive, or your local gas station because gas is more, or your realtor because when in fact it was actually the government that bid up all of those things with money printing, and you didn't even know about it. So it is silent. It's a silent thief that takes from the poor and gives to the richest people, and it destroys the working class. And that's why I want to crush inflation. We need a policy that seeks to stop inflation at all costs.
Okay, so what would you do to stop inflation?
Well, we stop the money printing. You know, we need, and the money printing is just a means to fund deficit spending. Governments borrow to
define the deficit, for people.
So basically the deficit is the difference between what the government spends and what it brings in.
It's usually calculated on a yearly basis.
That's
deficit.
right.
Yeah. And the debt?
Well, the debt is just the accumulation of the deficits.
Right.
So the deficit right now is $62 billion. And
I thought it had a ceiling of
41 billion, right.
Wasn't that a ceiling?
Yeah.
Guess not, eh?
I guess not. Look, there are very real present-day consequences for that. Deficits increase the money supply. Central banks effectively facilitate that increase in the money supply, and that causes inflation. And it's why I have a buddy whose family moved here from Italy back in 1973. His father worked paving roads, and his mother made sandwiches in a senior's home. They were able to pay off their home 10 minutes from Parliament Hill in 7 years.
Right.
Their grandchildren wouldn't be able to save up a down payment for that home in 15 years, right. And they will be university educated with all the advantages of having been here 2 decades. That is the consequence of the money supply growing vastly quicker than the stuff that money buys. So what we have to do is stop growing the money supply and start growing the stuff money buys, right? Produce more energy, grow more food, build more homes. We have to unleash the free enterprise system to produce more stuff of value. And this is where we have to remove the artificial scarcity that the government is imposing on the population. Let's incentivize our municipalities to grant the fastest building permits in the world to build homes.
And you have a plan for that in principle?
Yes. I mean, I'm going to say to the municipal governments, they either speed up permits, cut development charges, and free up land, or they will lose their federal infrastructure money. So they will have a powerful carrot and stick incentive to speed up home building. And
the percentage of a new house price that's a consequence of government taxation and regulation?
Well, in Vancouver, it's 60%.
60%. Now, does that include the land and the house?
Yes, that includes everything. So I'll tell you how they calculate it. C.D. Howe took the cost of compared the cost of building a home to the cost of buying a home.
Yeah.
And he said, what's the gap between those two things? So they added up land, labor, profit for the developer, materials, and they compared that to the sale price. And they found the gap was $1.2 million. So that's $1.2 million of extra cost above and beyond the materials, the labor, the land, and the profit for the developer. So where's that going? Well, the answer is development charges, sales taxes, land transfer taxes, right. the delays in getting the permit, time is money, the consultants, lawyers, accountants, lobbyists that the developer has to hire in order to get the approval. So in other words, we're spending twice, in Vancouver, we spend twice as much on bureaucrats than we do on all other things combined to build a home. More money goes to bureaucrats than goes to the carpenters, electricians, and plumbers who build the place. And to add insult to injury, those tradespeople who build homes can't afford to live in them.
Right.
I mean, it is, so what we need to do is slash the bureaucracy. And I'm going to say to the mayors, you're not getting federal infrastructure money until you slash your development charges, speed up your permits. I'm going to take the federal GST off new homes under a certain limit and encourage the provinces to do the same. But we've got so much land. Like we should have the most affordable housing in the world. It should be dirt cheap because we have the most dirt. We just need to get the government out of the way.
Yeah, again, that was Dr. Jordan Peterson interviewing Canada's likely next leader, Pierre Poilievre, just a few weeks ago. Now, Poilievre, when discussing inflation and investing, he also brought up points that I've surfaced here on the show over the past few years. He even articulates a few things the way I've described them. It's almost weird, like inflation means that it actually makes sense to strategically borrow and spend and not to save. It's almost like Poilievre is a GRE listener. I love how he said, stop growing the money supply and start growing the things that money buys. We're talking about things like homes and energy and food. That was eloquent. I mean, in Vancouver, the percentage of a new house cost for taxation and regulation is 60% of the cost of the home, fully 60. And then, if that's not surprising enough, due to all these layers of regulation, the cost of building a new home is $1.2 million more than the cost of buying an existing home. Just astounding. This might have even left you either flabbergasted or gobsmacked. Which one? So, some parallels to the U.S. there in Canada, but back here in the U.S., the housing market is clearly more affordable and healthier. Poilievre really pointed out a direction that the U.S. does not want to fall into. In fact, we've got a pretty good Canadian listening contingent, so let me ask, do you have a connection to Pierre Poilievre? If you do, we would probably like to invite him here onto the show with us. If you do, or you even know someone that knows someone, let us know. Write into getricheducation.com/contact or email us directly at info@getricheducation.com and we'll make that happen. Now, what is happening at GRE Marketplace right now is that our listeners are getting brand new build investment property in Florida and some other places at competitive prices and a fixed interest rate of just 4.75%. So, yes, that is sub-Canadian prices by far, below Canadian prices, and a 4.75% rate. And then on top of that, you get to pay an affordable insurance premium in Florida because it's new build, or similarly, it's that way in other states if you buy new build. But builders overbuilt in some pockets of Florida, like I've mentioned to you before. So at this time, on top of all that, they're offering a free full year of property management. And because when you own a new build property, it's not occupied with tenants on day one. And this means that you don't inherit unknown tenants. And builders are also offering you up to 3 months in a rent guarantee in case your single-family home or duplex or fourplex is not occupied yet. The builder would pay the rent for you. Really amazing incentives, but probably none better than that 4.75% mortgage rate. I mean, it's like you get to roll the clock back to when rates were artificially low back in 2021 and 2022 and lock it in now. Our GRE investment coaches connect you with the investment property that's right for you based on your needs and your goals, including those 4.75% rates if you so choose. It is all free at GRE Marketplace from gremarketplace.com. Just click on the coaching area and you can book a time right there. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.